What is public limited company? A public limited company is a designation for companies which trade publicly on the stock market. This type of enterprise is very common in the Commonwealth countries. There can be an unlimited amount of shareholders in a public limited. Anyone can have part in the ownership of a public limited. Finally, companies issue stocks, which are then traded in the open market in a public limited. How are profits distributed in public limited? The profits in public limited are distributed in the form of dividend. A dividend is a sum of money paid regularly to the shareholders of company by that company. Moreover, the more shares one owns, the more money they make through dividends.
How do public limited companies make their capital? Since this type of company is open to the public on the stock market, people are able to invest in shares. This means that the sole trader is having some of their company bought off them, which means they are making loads of money. Unlimited shareholders result in unlimited capital. However, there is a catch, which will be discussed in the disadvantages.
What are some of the advantages of this type of company? Since a company has limited liability in this type of enterprise, it means that they won't go through as much unlimited liability. Secondly, this type of company provides separate legal entity, meaning the company still continues. If the shareholder dies, large amounts of capital can be raised as well.
Now the disadvantages. Firstly, this type of business is very costly and time-consuming, as it requires loads of legal formalities to set up this enterprise. Secondly, being open to the public on the stock market makes the accounts of these companies accessible to anyone, which interferes with its privacy. Lastly, these businesses tend to get out of hand easily since they grow pretty big. The end.